Well, hi, just another opportunity to do a very brief update. I wanted to dive in today into a very important question. Why have interest rates went up so much in such a short amount of time? Now, if you would have asked us January and February that if I thought interest rates would go up so much so quickly, to be honest with you, I would have not seen that happen at such an aggressive pace. Now, I want to give you some insight on a couple things that have changed that have made that happen and why I think we should not panic, and also, some things to watch for. So first thing here, a big reason why interest rates have went up so quickly by so much, is pressure on the Bank of Canada. And so if you look back to the 2008 financial crisis, by and large, Canada's central bank, headed at that time by Mark Carney, who then moved on to the Bank of England, was widely celebrated as being, the Bank of Canada that had handled things better, the central bank that had the best competence. And so there is a huge amount of pressure on the Bank of Canada, where they have this strong reputation of always, being, more competent than lots of banks out there. And what happened this year is that we had a situation where, inflation was labeled as transitory, which means that inflation is here temporarily, but it's going to go away, and then it's not gone away. And a lot of people put that pressure and say the Bank of Canada has not done enough to slow down inflation, which is the cost of your goods, the cost of food, the cost of gas, the cost of housing is all escalated, and that they have not done anything to change that from happening. And one of their key tools is changing the overnight rate. So the Bank of Canada in the short term has been wildly panned by politicians from both party stripes, saying that they have not been competent. And so that particular pressure has made it seem the Bank of Canada must do something to feel that they're pulling all the stops to control inflation. This is different than earlier this year because they weren't feeling the pressure where they were at fault or anything like that. Where now squarely they've been put into the crosshairs as that they are the result of not doing enough. And so what's happened is the idea behind raising interest rates is that they are saying that that they want it to look like that they are doing everything possible to slow down inflation, and their best tool is upping interest rates, the overnight rate, to slow down growth. And so that is a pressure that was not there earlier. That is a pressure and criticism that was not existing last year and the early part of this year. And so now that's in place. The Bank of Canada is at fault. And now they're kind of saying, screw you, we will make it known that we didn't, that we did whatever we could to slow inflation. Now, so that is reason number one, which is not a great reason, but a true reason. So, and probably not something that's all that comforting, to be honest, as well. The second thing we have to remember here is, why did the Bank of Canada behave in the way they behave? So let's go back to a situation prior to COVID putting in restrictions in, which is March 2020. And so what we had in that situation is we had a housing market that really was coming into what we believe would be a really strong year. January, February, March of 2020, in most markets were looking very strong, some good price growth. And then what happened is that in preparation for what we thought would be huge economic fallout, the Bank of Canada decreased rates by 3 times over the course of a few weeks. So emergency, no meetings, decrease rates over the short term, over the course of a few weeks. And so at the very first prediction we had at that point was that there was already a lot of pent-up demand in the market, and if there was going to be no activity, which there wasn't in 2020, in the spring of April and May, that we're going to see all that activity push into the fall, which would create a buying frenzy. Now, that's exactly what happened, and then on top of that, we created a number of other situations. First of all, we created people that had situations where they were locked into their homes and they found the home didn't work for them. So now people that were not thinking about upgrading decided upgrading. Now people that were that had a particular home, maybe it was a condo in the city, now they're looking at houses that'd be more rural. So all these things started to really snowball into the market, creating a crazy market. Now what happened during this time frame is, because of what had happened in early 2020, we still have really, really low rates. Now, the proper thing in most historically would have been, as a market heated up, that's where you're going to increase rates to slow growth. Now, that didn't happen in 2020. That didn't happen in 2021. They didn't slow any growth by increasing rates, even though the market was on fire across the nation. And so why did that happen? Because what we saw is that even though the housing market was really strong, we had a number of industries. I'm thinking about restaurants. I'm thinking about retail that were not able to operate at full capacity. Even if a restaurant wanted to be full capacity, they were not able to operate full capacity because of COVID rules that said we don't have enough people. We might be takeout only. There was staffing shortages. All these kinds of things means that they were crunched on their ability to make cash because of COVID restrictions. And so upping the interest rates on those folks would have been far more disastrous than increasing interest rates with the idea of slowing the housing market. So there's where we sat during 2020 and 2021. So what changed remember the first Bank of Canada meeting in January, no rate change. What changed in March? First of all, we finally had a situation where COVID restrictions were coming off in the vast majority of provinces. And this means that this is the first time that almost all industries were able to operate at full capacity. And it was the first time the Bank of Canada had the opportunity to say, hey, now we're kind of operating on full cylinders, and now is the time you can make the most amount of money. And it's going to, probably from their perception, a rate change could hurt the least than it would have been a year ago in relation to those industries. Now, so that is one reason why that's the opportunity where they had to increase interest rates. Now remember, when an economy is strong, interest rates go up. When an economy is in recession, interest rates are going to go down. Now what's also happened since the beginning of this year is that the idea and the data, this involves the inverted rate curve, it involves a lot of things, has strongly suggested, and last year we're talking about inflation being transitory and going away, there's very little chatter around recession, but now as the years went on, there's more and more stronger chatter that we are heading into a recession. And the problem when we're heading into a recession is that we had a situation where rates should have went up a year and a half ago on a more steady basis to control the housing market. Now what we have is we have an impending recession, we have the lowest rates of all time, and the only way to control recession is to lower interest rates. Well, how do you lower interest rates when they're already at record lows? And so when we start the year, we don't have as much of a feeling towards we're going to a strong recession. Now that's getting stronger and stronger as the months and the weeks go on. And so what's happened is that the Bank of Canada is building margin. And so the higher and the quicker they move interest rates up, the more certain they are of a recession coming, I would say 12 to 18 months down the road, where they would have to use the tool of decreasing interest rates as a tool. If they had interest rates what they had in January, they're in a lot of problems because they would have a recession where they'd have to have some tool to stimulate growth, and they wouldn't have it because interest rates are already so low, they can't move it farther. So what would happen in a recession in that scenario is that they would want to stimulate growth, want to stimulate people spending in the economy, but would have no tools to do so as far as the interest rate perspective goes. That will become a major problem because you would not have the ability to kind of rev things back up. It's kind of like saying, hey, I have, it's maybe even a bad illustration, but I have a car, it's all set to go, it all looks good, but I have no ability to get gas to put into the car. And so now what we see in the second thing, as opposed to political pressures, we see the certainty of recession on the horizon and time coming quicker. Because what we also see right now is we see that the time frame predicted when a recession would occur has accelerated. And so when you see interest rates go up quickly and more than you thought, it's because a recession's on the horizon and they have to have the tools to do something with it. The last part of the puzzle here is that we still have not controlled inflation. And so this kind of weighs in the first the first factor here. And I'm also relating to the fact that we're looking at the Fed, which is the American version of the Bank of Canada, having an interest rate meeting this week, and they're talking about a big rate increase. Remember, interest rates on a mortgage are not affected in the same way in the United States as they are in Canada. And so something like a variable rate holder may not be affected in the United States in the same way. So it does different things by the Fed changing rates. This is an important distinction when we hear people talk about, hey, it's just like the 80s. Remember, the 80s, the Bank of Canada set rates in a different way, so it accomplished different things by moving the rates up and down. But with inflation still being rampant, is moving rates really helping? This is the problem. interest rates are not actually, the increase of interest rates are not slowing down the inflation, because you have issues with inflation that are not pertaining to anything to do with interest rates and that type of thing. But on the flip side, you do have with interest rates going up, you do have housing slowing down. You do have a disposable income happening, where there was less disposable income, slowing growth in that area. The third thing you have is something that if you would have talked to me on the phone in the last couple of years, you would see one thing I really noticed about the market is something called house hoarding. So I met a lot of people were going, hey, I have this house I live in, I have a second home, maybe it's a condo, maybe it's a place, maybe it's a cabin, and they weren't renting that out anymore because the cost of borrowing was so cheap, there was no reason to rent it out. So now what's happening is you're seeing people saying, well, now it's more expensive. I'm going to rent out that second place. I'm going to rent out the rooms or whatever it might be, and that's going to create some more housing opportunities and decrease the pressure on housing, because that's a big thing right now, is that a lot of people a lot of housing is sitting underutilized. And so by increasing interest rates, that's going to happen as well. And so I want you to take away from this that yes, interest rates have moved up a lot and quickly, but what do I predict? I predict interest rates are prepping to go back down. Do I think that's going to happen in September, October? Probably not, but 12 to 18 months seems very realistic to me. I would hate to have clients lock into a fixed rate that incurs the interest rate differential penalty that is going to be locked into a rate that's much higher that might be down the road. There's an article, and we did a separate video on that talks about the interest rate, the borrower is going up by 45% in their borrowing payment. Do you realize, and we talked about this in another video, that the rate they're quoting is lower than the rate today? So they're quoting that borrowers will renew at something higher than they had 2 years ago, but lower than today. So by their own admission, they believe that interest rates are going back down. And so if you have any questions, please reach out. We love to discuss your scenario. We found a lot of solutions that even in the short term can help you manage that cash flow. There's different things we can do with your mortgage to give you room if you're frightened, or if you want some other kind of advice in that area. If you have a friend that you know needs a video, please share with them, and do take the time to like and subscribe to our YouTube channel. You could really help us out in that way and making sure we can get these messages out to people. As always, have a great week.